Welcome to your weekend review for the week of Monday, May 6th, 2022. Start off the week with stocks up early in the morning based on China's easing of restrictions based off of their COVID flare-ups. It's going to be a pretty light week in terms of data. No Fed speakers as we're in the quiet period before they have their meeting next week. So all eyes this week will be on the CPI inflation number that comes in on Friday. And then we have a couple of auctions along the way. There'll be a total of $96 billion worth of government debt issued this week. In the 3-year auction tomorrow, we'll see how that's going to go. Kind of give an indication what the market sentiment is. Also, for what it's worth, is market's pretty much accepted there's going to be a 50 basis point change next week. Then also into August. Now they are planning on basically Fed Fund futures have a 60% chance of 50 basis points in September. After starting the day up a couple of ticks, we ended up down 42 basis points on the day, and the 10-year Treasury is up quite a bit in the after hours trading. Pretty much all day we're battling these technical levels at the 25-day moving average, and then actually making a run down to actually two Fibonacci lines lower at 100.56. So we're kind of trading right in that range. As you can see, the MBSs have been fighting that 25-day average for a couple of weeks. Kind of combo of factors here. We had a low liquidity, low volume day, which makes any move things a whole lot bigger. There's some concerns about the supply of bonds, that there might be a whole bunch of corporate bonds coming to market. Bad day for Euro bonds, the looming Fed decision, the CPI number on Friday. More and more smart people are predicting the recession next year, predicting that the 10-year will come back down under 2% when that happens, which is good for us and bad for everybody else. Then a great note this morning from MBS Highway. They kind of did the math on it, and basically it looks like we've seen about 140 billion less issuance in the first 5 months of the year. If everything remains the same, we'd see about $98 billion less available MBS because we're just not doing as many of them. In that time period, the Fed is going to continue to reduce their balance sheet. So as long as demand stays the same for bonds, the lack of issuance might help make up for what they're running off a little bit. We'll have to see how that plays out. Which brings us to Tuesday, June 7th, 2022. Stocks are lower this morning after a profit warning came from bellwether retailer Target. MBS, bonds and MBS are actually up on the day. I typed that wrong. Basically, Target made a profit warning saying that it might have to discount a bunch of its inventory in order to move it. Meanwhile, I was at the mall last weekend and there were lines to get into Louis Vuitton and Prada. Go figure. But consumption is about 70% of our economy, so warnings from retailers like this is kind of a red flag. Atlanta's Fed GDP Now model has Q2 GDP coming in at 1.3%, which is pretty lousy considering it was a negative number last quarter. The elephant in the room that's going on right now is the Fed winding down of the balance sheet, which started at the beginning of June. They're basically going to try to strip off and sell about $3 trillion worth of bonds over the next 3 years, which is adding a lot of supply to the marketplace. So the big question is whether or not people are there to buy what the Fed is selling, plus all of the new bonds to just pay for what's going on in the world right now. So that's going to be the big question that needs to be answered here over the next days, weeks, months, and years. Yeah, the day started off right off the bat, being up about 11 basis points on the MBSs, up to 17. High is 34, and then closing the day out up 30 basis points total. Tesla and SpaceX CEO signaled that he might actually walk away from his potential $44 billion acquisition of Twitter. So Elon Musk might actually walk away over the percentage of fake accounts on Twitter. Guess you're going to buy a business, you want to find out how many customers they actually have before you pay that much money. Moving on to Wednesday, June 8th. Bonds opened on the wrong side of flat. Early on, they're just down 9 basis points, which compared to the swings we've seen lately isn't all that bad. And stocks were pretty flat as well. Basically, bond traders are mulling two distinct options, either fresh bonds sell-off thanks to red-hot inflation or a sustained rally based off of recession risk. So basically what it all comes down to is the Federal Reserve is trying to finesse a very big operation where they sell off their balance sheet without causing a relation.
One scenario is that the 10-year yield could jump up to 4% on inflation fears. The other side is that the economic hurricane, as coined by Jamie Dimon last week, could send us into a recession, which will ultimately lead to yields falling. Today, the MBS range, basically all day we ended up being down 14 basis points, but we're essentially trading this little range right here between the 25-day moving average, which is the bottom red line, and a Fibonacci line at 101.063. So we've been basically range trading that section for a while, trying to determine if it's going to fall through there and drop all the way down another half point, or start making a run up higher. So hopefully it makes a run up higher. The World Bank today also cut its 2022 global growth forecast from 4.2% down to 2.9%, which is a pretty sizable drop for the world's growth rate. And like I said, that is the whole world. We also got a survey out of Zillow and Pulsenomics, which basically said that the average appreciation rate on homes over the next 5 years is predicted to be about 4.8%, which nets out to about 26.4% over the 5 years. Only 35% of respondents thought that we were in a housing bubble. Only 29% think that the Fed's going to pull this stuff off. And it looks like about 59% of people think we've reached peak inflation. So that's where we're at for the day. We're going to continue to watch for the rest of the week as these bonds move into these ranges and see how it plays out. On to Thursday, which turned out to be a pretty volatile day for the market. Everything kind of started out with the European Central Bank basically making moves saying that they're going to move away from the zero interest rate environment, going to end their quantitative easing and start raising rates. The German Bund, which is fun to say, was at about 0.25% a few months ago. It's now all the way up to 1.5%. So that's kind of rippling through the bond market in general, the world's bond market. Stocks and bonds sold off at the announcement, with the 10-year going towards 3.05, which is pretty much about where it closed out on the day. So initially bonds were down, and then they leveled off a bit, and then they kept on going down. Initial jobless claims were up 27,000 at 229,000. That is on expectations of 206,000. Still really low, but the average is starting to trend up a little bit. The big thing that everybody has their eyes on is the CPI number tomorrow, which is a big number, both in terms of number and its importance. Pretty much the day, like I said, it started off down, leveled out a little bit, and then got much worse in late day trading. So I think everybody was preparing for a big CPI number tomorrow. So I think that's what the consensus is probably thinking as of the end of the day. So basically we're trading in this range. It's pretty much made a range here over the last month or so, right in this ballpark here. But basically we have a ceiling of 101.406 with a floor of 101.531. Which you can see at the end of the day was kind of making a run towards that floor. So we'll have to see how things open up in the morning. So saw as kind of an interesting factoid is, according to Curinos, which collects a lot of data on the market, in 2022, rate lock volume was down 42% year over year and down 6% month over month across all channels. So they look at wholesale, retail, all that stuff. And funded volume has decreased 40% year over year, and 5% decrease month over month. So that's what we're looking like on the day. And tomorrow we get the CPI number, which is going to be big and important. And on to Friday, June 10th, 2022. Ouch, rough day for the bond market. The bond market really didn't like the CPI number today. The market was expecting year over year inflation to come in at 8.2%, hopefully signaling a top. This is after an 8.5 reading in March and 8.3 in April. Nope, came in at 8.6%. Shelter, food, and gas were the largest contributor. Good thing nobody uses those. The core CPI, which strips out the more volatile food and energy components, rose 0.6 from the prior month and 6% over last year, also well above forecasts. The MBS is now broken below the 100.531 line, which is the new ceiling. The new floor looks to be par. If this persists, we're probably going to start looking at the 5% coupon pretty soon. Blew through that floor. We'll have to see how the market reacts to this coming into next week. Basically the entire universe of American homeowners have no incentive to refinance their mortgage. For example, this is as defined by refinance incentive being 50 basis points. At current lending rates, 99.9% of loans that make up the UMBS 30-year universe have no refi incentive. We did get a new post from our sponsor, www.wellthatmakesense.com. This is a reading notes from the How to Get Rich podcast with Naval Ravikant, who is a very, very smart man. The topic of today's post was, you can't be normal and expect abnormal rewards. You won't get rich renting out your time. Looking into next week in the bond market, we got PPI, Producer Price Index, on Tuesday. We have the FOMC decision on Wednesday, and then we got some building permits on Thursday. And those are going to be the main things that the market's going to be looking at. So I hope you all have a great weekend.